You're with us here on a fresh new edition of Trading Hour. The market is absolutely flat and we're up about 1/3%. 30-40 points is what the Nifty is trading with. I mean, off the lows, off the highs, that kind of a day. But, well, I don't think there's anything to complain at all, given the kind of week that we'll be wrapping out off today. So, irrespective of whatever happens, I mean, even if the market sells down a little bit, you'd end up with at least 3% in gains. I mean, actually, as of now, we're up about 3.5% week to date. So, I mean, this is quite something. And you're just coming off on the back of that. Even global markets, I mean, you look at what's happened with the dollar, the equity indices, treasury yields, etc. Everywhere there has been a bit of pullback. On oil prices, it's been a bit of a pullback on the opposite side. I mean, they've been going one way down and there's been some change there on the upside. So incremental moves after very steep moves in one direction coming through today. So no real big change in terms of trend or anything of that sort. Quiet kind of day is how you describe it. 10,896 on the Nifty. With me is my colleague Ekta. Ekta, morning.
Hi Prashant, morning. Well, absolutely, and who can forget the fantastic November series that we've come out of, starting the December series on a positive note. In fact, for the November series, it's the best that we've seen all the way back since March of 2016. FII flows have picked up, so it seems as though maybe we're on a better and more firmer footing for the markets, even going into probably the December series. Not to mention that we do have the G20 meet, so we are going to be watching out for what exactly Trump and, you know, the Chinese president could probably pull out of their hat, and could be a trigger for the markets. But in any case, let's get going in terms of all of the cues that we need to watch out for. We have Mitesh Thakkar joining in to talk about the technicals of the market this morning and what he's strategizing. So Mitesh, over to you. Stocks as well as index.
So I think, index one, the structure and the overall direction still remains on the upside. The only worry for me is that we have quite run away from the intraday moving averages, and that's slightly overbought. I think still the way to approach index would be to possibly trail your stop loss, maintain your long bias. 10,870 should be your fresh stop loss on the spot levels, and I think 10,950 the first target, though eventually there's a good chance that we might head towards 11,050-70 as well on the upside. So maintain a long bias, but trading for the time being, since I don't have a trade on index, it's been more stock specific basis. And two stocks which I would recommend right now, one would be a buy on Tata LXI with a stop at 1,012, look for targets of around 1,050, and Sun TV is a sell. I think there was some negative brokerage report as well. It's a sell with a stop at 607 for targets of 570.
Mitesh, any thoughts on Yes Bank? Very short term, I mean, where are levels?
See, I think Prashant, when the stock was, trading a few weeks back, every now and then the stock took support around this 180, 178 zone. So there could be a pullback to those 175, 180 levels broadly. I think around those levels you should see some kind of fresh supply emerge again. The stock was extremely oversold. It's had a good short covering yesterday. This bounce back, I think, should taper off around this 175, 178 zones.
Okay, Mitesh, I think we got some questions. No, I don't think we got Twitter questions today, but we will have those and we'll put them to Mitesh as we go along. Thanks very much, Mitesh, for joining in on the show. All right, let's get you some opinion. The one sort of event over the week gone by which really sparked the rally was those comments from Jeremy Powell, the Fed chair. But we are heading into more event risks. All eyes are on Argentina as G20 leaders arrive at the summit due to start later today. It is one of the most difficult meetings in recent memory, with, of course, the trade war being the most pressing issue. Here is some opinion that we got from Mark Mobius on what he's making of the trade war rhetoric and the possible direction it will take.
We have to be very careful about the China-US trade war. I don't think it's going to be resolved anytime soon, simply because it's now not only about trade, it's about technology transfer, it's about rules and regulations that foreign companies, particularly US companies, have to endure when they go into China. And all these other factors are playing into this, in addition to the military side of things, where the US is beginning to say, now wait a minute, China is getting too powerful in the South China Sea. They're taking too much territory, etc., etc. So I think it's a wider issue that will take time to be resolved. I believe that a lot of the exports going from China to the U.S. could be well going from India to the U.S. or from Vietnam to the U.S. or from Bangladesh to the U.S., so forth. So there's a great opportunity for many of these countries to diversify their export base to the U.S. I think the U.S.-China battle will, in the next 4 to 6 months, will get worse, not better, because Trump and his team have really dug in their heels and said, look, we want some change on the part of China. And China, on the other hand, is also dug in their heels and say, look, we're not going to give away our $300 billion trade surplus with the U.S. easily. So, and don't forget, jobs are at stake in China.
In a bid to provide some liquidity to the sector, the Reserve Bank of India has relaxed rules for NBFCs last evening with respect to their loan book securitization. To discuss this, we have Mr. R. Varadarajan, MD of Repco Home Finance, and Kunal Shah, Associate Director at Edelweiss Financial Services, joining in to discuss this. Mr. Varadarajan as well as Kunal, thanks very much for joining in. Mr. Varadarajan, let me start with you, because this minimum holding period, which has now been reduced from 12 months to 6 months, that's primarily going to be impactful for housing finance companies because of the tenure of loans being above 5 years. So tell us, how useful is it for you?
You are right. When NBFCs, particularly housing finance companies, are facing certain liquidity service, only few, not all. This type of move by Reserve Bank of India is a welcome step, because they have done two things. Number one, the minimum holding period they have reduced to 6 months, and all the loans above 5-year tenure are eligible. That means housing finance is the major beneficiary of this decision, and this will definitely ease the liquidity. But as far as Repco Home Finance is concerned, so far we have not done securitization because there was no need for that. Even during the recent crisis, we never faced any liquidity crisis. But nevertheless, it's a good signal. We are keeping our options open even for securitization now.
Mr. Varadarajan, so what this means is any loan that you made which is older than 6 months and over 5 years in tenure, I mean, you got easier terms now. Banks will be able to buy this off.
Yeah, we have the pool. We have the pool, but banks will look at, when you are reducing the period to 6 months, because they have not seen the repayment track of that particular loan. Therefore, they will be interested to see the general corporate governance of the company, as well as the behavior of such loans in the past with that particular company. Since our company, we have both salaried and non-salaried pool with us, and according to me, at least 80% of my loan book becomes automatically eligible. We may not do that, but still, as far as the eligibility is concerned, most of the loans become eligible because those who cross 6 months, and almost all the loans are above 5-year terms only because housing loans.
Sure.
Even LAP loans are above that only. Therefore, most of the loans become eligible for the pool. But it all depends on, what is the rate at which we are getting and how beneficial to us. And we will look at all these options. That's why I told you our options are kept open.
Okay. So that point is taken, Mr. Varadarajan. But what about your exposure to, say, the loans against property segment or the developer segment? How much of your loan book is currently exposed towards that segment, and what kind of trends are you seeing? Because the concern in the market is that, asset quality is a risk there.
Yeah, you are right. But 18% of my loan book is in the LAP segment. Earlier it was 21. It was consciously reduced to 18%. But we do not have any exposure to developer loans. From the beginning of our operations, we have a policy that not to lend to the developer loan because of the inherent risk involved in that. Therefore, we do not have any loan to developer as of now.
So your LAP segment, what kind of trends are you facing there in particular? Because you've reduced your exposure consciously.
Yeah, because particularly we had some problem of the asset quality of the high ticket size. Therefore, we were shying away from the high ticket size for the new loans, and that has helped us to bring down to 18% of loan book under LAP.
Mr. Varadarajan, what is from the buyer's side, right? I mean, RBI doesn't set rules for banks in terms of how much they can buy NBFC loans, etc. I mean, those are board set, right? Our bank board set that limit individually across the board. So, so RBI has eased rules in terms of what can be done, but is there enough appetite on the other side, on the bank's part?
It is. Appetite is definitely there, because we have been receiving queries from most of the banks for securitization. That's what we have seen in the field. Appetite is definitely there. But as I told you, they will see the pool and the inherent risk involved in that pool. Based on that, they will take a call. Their board will take a call.
Okay. Just a quick word before we let you go, Mr. Varadarajan, with regards to the liquidity situation at this point. How is it looking? Has it eased in the CP market?
No, see, we have all the CPs which we were holding earlier, that we have repaid. Nothing is outstanding as of now. But we are only looking at the interest rate. When the interest rate is favorable to us, we would again go to the CP market, because the liquidity is very good for us. There is no issue. But the interest rate was prohibiting us from going to the CP market right now. Because when we can access funds at a cheaper rate from the banks, we go to the banks and then avail the loan.
Okay. All right, Mr. Varadarajan, we'll leave it on that note. Thanks very much for joining in and speaking with us. Well, Kunal, over to you then. What is your sense in terms of what's happening with the NBFC space? I'm sure you're flooded with client calls on DHFL as well as Indiabulls Housing Finance. So tell us, what are you recommending on them?
Yesterday's RBI's move with respect to relaxation of the securitization norms, wherein they have lowered the retention period from 1 year to 6 months. So, and that too particularly for the loan which are more than 5 years. So that helps the home loan segment. When we also calculated in terms of what could be the incremental pool which can become eligible for securitization or assignment, we believe like 10 to 15% of the outstanding loans now becomes eligible. So that really helps. We have seen the liquidity, as highlighted earlier as well, the liquidity scenario and the debt market activity levels have come back to 70-80% of the normalized levels. So particularly on the liquidity as well as various RBI's measures which have been announced, that is benefiting the housing finance companies.
All right. Kunal, just to move away from NBFCs, I don't know if you heard the Yes Bank management on the air this morning. We had Rajat Monga from Yes Bank clarifying on a whole host of issues. Do you have coverage on Yes? I mean, any thoughts on what your view would be after the very steep correction we've seen?
Yeah, so we do have coverage on the stock, and we had seen lot many developments out there, be it at the board level as well as the succession planning is something which will be critical, as we will see something getting finalized, say in a couple of months' time. So that will be the key trigger as such in terms of how things unfold. Fundamentally, we just had the Q2 numbers for them, and there we had not seen any stress, and the growth has been pretty much sustaining. Now we'll have to look at as to how the overall financial performance is in the second half. So fundamentally Q3 is something which will be weighted for particularly with respect to the asset quality performance and the RBI's divergence report, and largely the update in terms of the succession planning. That is something which will drive the stock from here on.
Okay. All right, Kunal, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the view coming in from Edelweiss, but we need to shift focus now to the commodity space. Manisha Gupta is with us now. Manisha.
Thank you so much for that, Ekta. Well, last day of November, and we have seen very volatile commodity prices in this month. Let me start about the crude oil prices, where we have seen a decline of nearly 22% for the month of November. That, of course, has been the worst performer. But when you look at the metals as a prices, we have seen very sharp declines come in for that one as well. The worst performance, of course, has come in from steel prices, where we saw nearly 20% of decline come in. Gold and silver clearly are closing this month on a positive side. But there you have the metal chart chart and everything is really in the red. The only performance that has come in on the positive side has been from copper. That is because 1, the metal is in deficit, and 2, the markets are looking at stronger demand. The imports into China have been on the higher side, and of course the construction infrastructure story is something that seems to be working well for that metal as well. But Mark Tu of Wing Fung Financial now joins us to talk more about that. Mark, hi, thank you so much for joining us. What is your sense now for the industrial metals, and how are you approaching the G20 summit, where there is an expectation that we might hear something on the trade negotiations from US and China?
Thanks for having me. I tend to think that the investor sentiment right now is actually having a wait-and-see attitude, because it is really hard to say whether there will be any agreement or, if at all, from the leaders in G20. And also because we can see that there has been some changes in the attitude of the Fed chairman for the monetary policy, whether you call it normalization or you may call it the rate high cycles. We can see that there should be some kind of uncertainties, and we are going to reassess the overall pros and cons of different assets for reallocation. So at this moment, I think gold should be a very good bet, because in a sense, for any risk-averse investors at this moment, we should have some portion of our wealth in something like gold, because it is so physical, and because it is in a sense it is more like a currency de facto. So I tend to think that at 12.20 something, it should be okay for us to find some support, and we may even look forward to having 12.50 or even 12.60 by the end of this year. But of course, we still have to wait for more hints from the Fed chairman or even from the economic data, whether there should be more rate hike, for example, once per quarter in year 2019. But for
Mark,
December, I think the FOMC should be okay.
Sure, your point is well taken, Mark. But how would you then look at the allocation into various commodities, assets, or funds as we get into 2019? What is your sense? Of course, there's a lot of uncertainty, but are you willing to park much of the funds at this point in gold, or would you look at crude in any sense? Are you also looking at industrial metals? Do you see the growth story come back yet again?
Very, very good question. For the coming few quarters, I tend to think that the uncertainties will be around us. So I think the proportion of gold should be positively correlated to the slowing down of interest rate hike. Suppose we have 2 more times in the first 2 quarters in 2019, we can expect that gold price to reach 1,300. So in that sense, I'm more bullish than before. As we can see at this moment. Okay. We are still waiting for some more data.
Absolutely. So while you are quite bullish on gold and you're looking at 1250 by this year and 1300 in the next couple of quarters, are you equally bullish for silver as well? Do you see a $15 or a $16 per ounce come in any time in the next couple of quarters?
For silver, I think it should be okay. For I suppose we have roughly the same the rhythms in the market that we can see some co-movement between gold and silver. $16 for silver should be relatively okay. Suppose we can see the slowing down of the Fed rate hike in next year. Sure. But that is based on that kind of assumption. But that kind of assumption is not really reliable at this moment.
Point taken, Mark. Thank you so much for joining us. So clearly, gold emerges as a better buy opportunity within the precious metals and even for the industrial metals for that case.
There's news at the bottom of the screen. Supreme Court provides relief to Reliance Communication. In what form, shape, we're yet to determine. But that's the one line which is coming through. And we'll have Ashmit joining in, our courts reporter, to tell us exactly what this relief is about. Remember, there was some trepidation about the spectrum trading deal with Reliance Jio. I think Arcom had told the courts that DOT needs to accept the land parcel as security, and that would be required for Arcom to be able to clear past dues, etc. And if that was not the case, then a deal with Jio for spectrum would not be possible. Ashmit is with us to give us what the Supreme Court is telling. Ashmit, take it away.
Well, what's interesting is that the bench that was hearing this matter was the same bench that had in fact earlier directed Arcom to make that settlement payment of 550 crore rupees to Ericsson, and that is in fact the principal argument that Arcom had used today. That earlier the Supreme Court has directed for payment of settlement dues of 550 crores to Ericsson by December 15th, and that if this transaction doesn't go through, then that payment to Ericsson will not happen, amongst the other bigger collateral damage. In fact, the counsels for Arcom went a step further to even say that Ericsson is just one part of the collateral damage. There are other dues that are recoverable, that the lenders will take a beating. They will have to suffer a huge cut if this spectrum sale deed is not allowed. They also said that the DOT itself would suffer, given that once this transaction is through, DOT would then become eligible to get 10,900 crores of deferred spectrum dues. So essentially, they impressed upon the court that this clearance is critical as far as this transaction is concerned. And on the back of that, the Apex Court has clearly held that this is a transaction that needs to go forward. On the back of that, the Apex Court has given very clear directions that the DOT must be content with merely a corporate guarantee. Keep in mind that the DOT had sought a bank guarantee to the extent of nearly 2,500 crore rupees. However, by way of this order, by way of today's order of the Apex Court, they will have to stay content not with the bank guarantee, but rather with a corporate guarantee issued by Reliance Realty only to the extent of 1,400 crore rupees. What they have to do in return, what the DOT in fact has to do in return, is that within 2 days, Reliance Realty will issue the corporate guarantee, and a week after that, that is the time that the DOT has to come back and to issue the necessary NOC to allow for the transaction to go through. So as of right now, all decks have been cleared. The way has been paved. The DOT has very, very clear directions to make peace with the 1,400 crore rupee corporate guarantee and to move forward and to issue the necessary clearances and the nod that is required for the Arcom RGO spectrum sale deal. Back to you.
If you could just reiterate the point with regards to the lenders and the kind of relief or the argument which was made on behest of that.
Well, one argument that we have seen throughout the proceedings is a plea that has been made by Arcom that this is that they're already facing insolvency proceedings, and then on the back of that, it is the lenders who are actually in charge. It is the lenders who are pushing for this entire transaction, and it is the lenders with an exposure of nearly north of 45,000 crore rupees that they stand to lose or gain the most if this transaction goes through or doesn't go through. And on the back of that, given the large numbers at play, and given the fact that these are large public lenders who are dealing with public money, the argument that was impressed upon the Apex Court was that this is public money eventually at the end of the day, and public lenders who will suffer, who will take a beating, who will have to take massive haircuts if this transaction is not allowed through. And that argument is something that the Apex Court, at least by the look of things, appears to have bought into, appears to have agreed to in allowing this transaction and in allowing the DOT to move forward to accept the corporate guarantee and within 7 days' time issue the necessary NOC to allow for this Arcom RGO spectrum deal to continue.
Okay, all right, Ashmit. Obviously, the stock is just flying away on the back of this news and the fact that it's going to be a corporate guarantee and not a bank guarantee which will be issued by Reliance Communication, and obviously it will be relief to lenders as well. So that's the important piece of news which is coming in with regards to Reliance Communication. The stock, as you can see, is at the high point of today. Thanks, Ashmit, for that. Let's get to Ashwini and discuss the technicals of the market now. Ashwini, over to you. Stocks as well as index, what are you recommending?
Well, it's clear that the market is very strong, and since morning you've had a mild consolidation. Now my sense is, given yesterday's momentum and today's action, the market will move forward only when the banks start to move. So my sense is that people should buy into the banks right now, and chances are a lot of the banks could recover by the end of the day. Particularly you are seeing buying on several of the large banks from lower levels, HDFC Bank, Kotak, etc. So this is a time to get long on the market, keep decent stops, but overall I would think as FIs come back, you should have at least a positive closing. Now, having said that, Oro Pharma is a buy with a stop of 798, target of 820. VIP Industries a buy with a stop of 529, target of 550. And Apollo Hospital is a buy with a stop of 1275, target of 1320.
Okay, Ashwini, thank you very much for that, and good getting those trading ideas from you. Well, Ashwini, of course, comes back in about an hour. We focus on a stock which has been flying now for the last many trading sessions. It was at 60 rupees about 6 or 7 trading sessions back. It's at 85, 86 rupees. That's a 45% move in the last 7 sessions. I'm talking about Kesoram Industries. We have some news coming in. Sonia is standing by. This is a CNBC TV18 exclusive. Sonia, over to you.
Well, thanks a lot for that. You know, for the last many years, actually since 2012, there was talks of a demerger of Kesoram Industries tire business. In the FY18 annual report, the management did mention very clearly that they're looking to induct a strategic partner into the tire business because it's been reeling under losses for many years. Now we understand from sources that a demerger is expected very soon. Within the next fortnight itself, something could close. Now, the main rationale for the demerger is that the tire business has been making losses for many years now. Over the last 4 years, the tire business has seen a loss of over 1,000 odd crores. The revenues of the tire business have also fallen. Remember, they manufacture and sell tires under the brand Birla Tires, and the reason for the big losses is that they've primarily been in the commercial vehicle bias tire space, and there's been a huge shift of demand from bias tires to radial tires, because of which they've lost a lot of market share there. They're also not present in the high value, high margin passenger tire business, so they are looking to induct a strategic partner. Step 1 will be the demerger. Step 2 will be inducting a strategic partner and either forming a JV or perhaps even listing of that separate company. We don't know. But for now, we know over the next fortnight, a demerger is on the cards. Also, the debt of the company is pretty high, more than 3,000 crores of consolidated debt, out of which the tire business itself has about 800 crores of debt, because of which a large part of the EBITDA is being eaten by interest costs, on account of which the need of the hour is to do a demerger. So let's see, this news flow has been in the works for a while, but we understand that finally over the next fortnight, something may see fruition.
Well, the Yes Bank stock continues to be in focus. In fact, it's bounced back today after falling for the last few sessions. We had an exclusive conversation this morning with Rajat Monga, the Senior Group President of Yes Bank, who said that the RBI has access to all the information, including other group and promoter companies. He also said that reports of Rana Kapoor eyeing chairman's seat has been taken out of context. Listen in to that exclusive conversation.
The RBI has access to all information, including this. So the structure of these companies is independent of the bank. It is not right to call them group companies. Okay. They are promoter companies. So they are the group companies of the promoter structure. So they're not a group company of the bank. There is no interest or dealings of the bank with these companies. Mr. Rana Kapoor, who's our CEO as well, has already conveyed his ownership in these entities to his family. Okay. So he himself has no interest in those entities either.
Mr. Kapoor does not have any interest in Morgan Credits or Yes Capital?
That's correct. So his ownership does not have any linkages to those two entities. Those two entities are entirely his family's entities. And the bank has no relationship with those companies, and therefore do not entitled to be called group companies in the nature that we were discussing.
The other big concern that shareholders have had is the exposure that Yes Bank has to NBFCs and HFCs, perhaps even to developers. Can you share some numbers?
So let's start with the HFCs. Our exposure is 3.2%. And when I say exposure, it includes all forms of risks that we may have exposure to, loans or bonds or off balance sheet. So it is all in the entirety. This portfolio is rated AA or better for 90% of the constituency of this portfolio, so which is the HFC portfolio. And HFCs and NBFCs have been through some liquidity, let's say, challenges in the recent past, and in our opinion, because the correspondences and conversations with NBFCs have been already very low over the last 3 weeks, so it is over in terms of the short-term challenge that NBFCs and HFCs were facing, which was the rollover of their short-term instruments and maturities. And banks have, including us, have stepped up to be able to carry them through their point of challenge. The next portion of our book will be NBFCs, which is about 2.6% of our total exposure. There, NBFCs, while HFCs do have much higher rating profiles, the NBFCs do have a stagger of ratings. Yes. So our portfolio there is about 90% more than A or better. Developers, again, as part of our third quarter disclosures, we had indicated an exposure mix of 5.6% to developers and 0 SMA2. So we have not a single loan to a SMA or to a developer which is extending beyond 60 days in terms of payment delinquencies. It's mostly construction financing. We are largely sole lenders.
Do you think there's been now quite a bit of pressure on Mr. Kapoor to perhaps sell his stake? The way the stock has fallen, and it's been talked about.
Yes, there should not be any pressure on him to sell down his stake. In fact, we believe him when he says that he will stay put on his holding. He also will know that these are times where there is deep value in the valuation. The share has corrected quite a bit. There is deep value. In fact, these are opportunities for us to sustain through these times.
There was talk that in that peace accord with the family, he spoke about his being chairman. Is that possible at all under the rules? If not CEO, he can be?
Current regulatory framework is very different. So as this few years have gone by, and you will notice with most private sector banks that the only person who can be a bank's chairperson is someone who is independent. And naturally someone who is of eminence. So it is something which is, in my opinion, being read out of context, because it might be of a structure of the past, but the current context of the structure is very different.
What would the capital raising plans be, and in the near future, will you tap the markets to raise funds?
There is a transition phase that the bank is undergoing, where we have more work to be done in terms of supplementing the board back to its strength. We are looking to appoint chairperson. We are also undergoing a CEO search. So as far as capital raising is concerned, I think the bank is already enabled by the shareholders to raise an amount of up to $1 billion. I think it will make more sense for us to look at that opportunity once these current uncertainties have been made more certain.
So we've got the market, which is right there. No big change per se from when we started, 18, 19 points higher. LIC chairman comments coming in. Surplus for FY18 is at about 48,000 crores. 5% is government share, which has been given today. And there is also a comment saying have transferred 2,430 crores worth of government share as surplus to them. Just quantifying that amount. So I don't know in what context this is coming in, but those are comments from the LIC chairman. We have Ajay Tyagi of UTI Mutual Fund who's joining in. Mr. Tyagi, thanks very much for your time. Good to have you here. You know, correct me if I'm wrong, but I remember the UTI Equity Fund had a pretty large holding as far as financials go. And out of financials, it also had a pretty large holding in Yes Bank. I think about 5% of the fund sometime in September, October was Yes Bank. Could you tell us, without going into what you've done recently there, but what's the right way to think about something like what's happened with Yes Bank?
I'm sorry, Prashant, I would not be able to comment on specific stocks in the portfolio. I can run my thoughts on the sector per se, but unfortunately can't be specific on any other names.
Okay. Okay, fair enough. If you think that your broad comments on the sector will hold true for that particular security as well, go ahead. Why don't you give us an overview? What do you think about that? Yes.
So again, while not being specific on any of the names, sure. I think my thoughts or our thoughts on the way we are carrying the financials exposure in the fund are basically to be focused on, first of all, private sector banks and certain select NBFCs. And if you have had a look at the fund, you would know which NBFCs I'm talking about. And basically the thought process is, institutions, basically banks or non-banking financial companies, which have had a very strong track record in terms of their ROAs and also consequently the ROEs, as well as have been strong in terms of gaining market share through the cycle, whether it's good times or bad times, are the ones which are positioned in the portfolio, and we hold a view on them for at least a 3 to 5 year perspective. So notwithstanding any one of them going through stress at any point in time, because financial companies do obviously go through stress every now and then, if our view on them from a 3 to 5 year perspective is strong, we continue to back up these exposures, again looking at the medium to long term perspective.
Ajay, shifting focus on the stocks which are sensitive to the rupee and the rupee depreciation, IT and pharmaceuticals, there's been a significant amount of a pullback which has taken place for the rupee. Is that changing your expectations on a couple of these companies or sectors?
Sure. Yeah. So firstly, again, while we are not particularly clued into where the rupee would settle at over the next few months, but I think our analysis does show us that for in an economy like India, where CPI inflation would remain 2 to 3 percentage point higher than the commensurate number for the US and therefore the US dollar, rupee ought to be depreciating at somewhere around 2.5 to 3% over the medium to long term. So we would see rupee settle down at lower levels year after year, unless until we address this issue of inflation differentials between two currencies. But there are always technical factors every now and then, widening current account deficit or expectation of narrowing current account deficit are technical factors which do lead to short-term currency movements. So our longer term view on the rupee remains that rupee ought to be weakening. I think it weakened very, very sharply, which to some extent, as markets always do, was an overreaction. It is right now stable at somewhere around 70 rupees to the dollar. This does not change our outlook on both the IT and pharma sector. Of course, both of them have their own individual demand supply factors in terms of the overall outlook for the business. We are more clued into those factors rather than just the movement of the rupee.
Opportunistically, Ajay, what else are you sort of really looking at across the landscape? Where are you seeing opportunities?
So I guess a sudden correction in both the IT and the pharma space basis rupee appreciating over the last 1 month has created opportunities in both IT and pharma. Like I mentioned, our analysis is more on the core factors, and for IT the core factors are the improving demand scenario in the US. We think that should continue to help IT companies pose a significantly better dollar growth number in the coming years compared to what they have in the past. In any case, if you remember, in the last couple of years, these companies were grappling with the issue of a very sharp appreciation in the rupee. The rupee, from a level of 67, 68 way back in 2014, did move to 62, 63 through 2017 and the first half of 2018. So I think with, if rupee doesn't really appreciate all the way back to 62, 63, which on a fundamental basis we clearly feel it should not, then I think these companies should also get some bit of tailwinds from the rupee as well. So from that perspective, and valuations have now become extremely attractive again after a 15 to 20% correction in many of these names, and on the mid-cap IT side, even higher correction. So we are looking at that sector. So is the case with select pharmaceutical names. Not across the board, but yes, selectively there is value there. We are looking at business models which are trying to address this issue of the generic pricing erosion in the US by moving up the value chain, getting into specialty and so on. At the same time, also looking into companies which are not too focused on the US markets but get a lot of their revenues from either India formulations or from other emerging markets.
Well, just about hovering 21, 25 odd points higher. We're just about hovering at those levels of around 10,900 for the Nifty. Done fabulously well in terms of the November series as well as for this week. So no complaints coming in. Only niggling worry is probably the Bank Nifty, which is currently down around 0.4%.